Welcome to Loan Programs, your comprehensive guide to understanding the four major mortgage loan types available to borrowers. Each program has unique requirements, benefits, and ideal borrower profiles. Let's explore conventional, FHA, VA, and USDA loans. Conventional loans are not backed by the government and typically conform to guidelines set by Fannie Mae and Freddie Mac. These are the most common type of mortgage and offer flexibility for borrowers with strong credit and financial profiles. Conventional loans require a minimum credit score of typically 620, though 680 or higher is preferred for the best rates. Down payment requirements start at 3% for first-time homebuyers and 5% for repeat buyers, though 20% down eliminates the need for private mortgage insurance, or PMI. Debt-to-income ratios are generally capped at 43 to 50%, depending on compensating factors. Conventional loans are ideal for borrowers with good to excellent credit, stable employment history, and sufficient funds for down payment and closing costs. The benefits include competitive interest rates, flexible loan amounts up to the conforming loan limit, and the ability to cancel PMI once you reach 20% equity. However, conventional loans have stricter credit requirements and larger down payments compared to government-backed programs. FHA loans are insured by the Federal Housing Administration and designed to help first-time homebuyers and those with less than perfect credit. The minimum credit score requirement is typically 580, though most lenders prefer 600 or higher. Down payments are as low as 3.5% with a credit score of 580 or above. FHA loans allow higher debt-to-income ratios, up to 50% in some cases. The property must meet FHA minimum property standards and serve as the borrower's primary residence. FHA loans are perfect for first-time homebuyers, borrowers with limited savings for down payment, those with credit scores in the 580 to 660 range, and buyers purchasing homes that need minor repairs. The advantages include lower down payment requirements, more lenient credit standards, and the ability to include closing costs in the loan amount through seller concessions. However, FHA loans require both upfront and annual mortgage insurance premiums. The upfront premium is 1.75% of the loan amount, and the annual premium ranges from 0.45 to 1.05%, depending on the loan amount and down payment. Unlike conventional PMI, FHA mortgage insurance typically remains for the life of the loan if you put down less than 10%. VA loans are guaranteed by the Department of Veterans Affairs and available to eligible veterans, active duty service members, and surviving spouses. One of the most attractive features is no down payment requirement for qualified borrowers. There's no minimum credit score requirement set by the VA, though most lenders require at least 620. VA loans don't require mortgage insurance, which results in significant monthly savings. The borrower must obtain a certificate of eligibility from the VA, and the property must meet VA minimum property requirements. VA loans are ideal for eligible military personnel and veterans who want to purchase a home with no money down, those looking to avoid mortgage insurance, and borrowers who may have limited savings but stable income. The benefits are substantial: zero down payment option, no mortgage insurance requirements, competitive interest rates, limited closing costs, and the ability to reuse the benefit multiple times. The VA funding fee ranges from 1.4 to 3.6%, depending on down payment and whether it's the first use of the benefit, but this fee can be rolled into the loan amount. Veterans with service-connected disabilities may be exempt from the funding fee. USDA loans are backed by the United States Department of Agriculture and designed to promote home ownership in rural and suburban areas. Like VA loans, USDA loans offer zero down payment for eligible borrowers. The minimum credit score is typically 640. The property must be located in a USDA-eligible rural area, and borrowers must meet income limits, typically not exceeding 115% of the area median income. USDA loans are perfect for low to moderate income borrowers purchasing in eligible rural or suburban areas, first-time home buyers with limited savings, and families looking for affordable home ownership options outside major metropolitan areas. The advantages include no down payment requirement, competitive interest rates, and low mortgage insurance costs. The upfront guarantee fee is 1% of the loan amount, and the annual fee is 0.35%. However, property location restrictions and income limits may disqualify some borrowers. In conclusion, understanding these 4 loan programs allows you to match clients with the best financing option for their situation. Conventional loans work well for borrowers with strong credit and down payment funds. FHA loans help those with lower credit scores or limited savings. VA loans provide unbeatable benefits for military members and veterans. And USDA loans offer rural home ownership opportunities with zero down. By mastering the requirements and benefits of each program, you'll provide invaluable guidance and help more clients achieve their home ownership dreams.